Welcome back, everyone, and welcome to another macroeconomics lesson inside the BullishFX institutional trader program. So today we are going to discuss something that has been confusing a lot of traders. Most of the retail traders do not really understand the relationship. Yeah, some do understand, but applying it now in the market is another story, right? So we're going to focus particularly on today's price action so far, heading into New York close, right? So we can see gold is rallying, and the Treasury yields, you can see that the top three on my portfolio, the 5-year, 10-year, and the 30-year, the Treasury yields are also rallying, right? And if you have studied intermarket relationships, you know that these two assets don't normally move in the same direction. So the question is, why is gold going up if Treasury yields are also going up, right? So that's what we're going to look into today. It's not going to be a long video, guys, so make sure you listen to the end. So by the end of this video, you will understand not only what is happening, but more importantly, why institutional traders are paying close attention to this relationship, right? So first things first, right? The normal relationship between gold and the Treasury yields, right? Before we understand today's market, as in today's price action, we first need to understand what normally happens, right? Gold is a non-interest bearing asset, right? In simple terms, if you own 1 ounce of gold today and hold it for the next year, that gold does not generate income. It doesn't pay interest, dividends, or coupons whatsoever. It simply sits there as a store of value. Now, compare that to US Treasury bond, right? When you buy a Treasury bond, you are effectively lending money to the US government. In return, the government pays you interest, right? That interest is what we call the Treasury yield. Now, imagine you're managing billions of dollars for a pension fund or a hedge fund. You have two choices. You can buy gold, which pays no interest, or you can buy a Treasury bond that pays 5% annually with very low risk. Which one are you going to choose? Pretty simple, right? Most investors would naturally choose the bond because it generates income, right? It generates income. This is why Treasury yields and gold usually have an inverse relationship. So what we are seeing today, in a nutshell, gold rallying. Gold has been up 1.34% on the day. And if we look at the yields, the 30-year 0.5, the 10-year 0.84, the 5-year 0.98. It was about 1% just now. So what we are seeing right now doesn't normally happen, right? When Treasury yields rises, bonds become more attractive. Capital flows into the bond market, and gold tends to fall. When Treasury yields fall, bonds become less attractive. Investors begin looking elsewhere to preserve wealth, and gold tends to rise. That's the normal relationship under normal circumstance in the market, right? But that's not what we are seeing as of today. We are not seeing that. So why is gold rising, right? Now here's where things become interesting. Recently, we have seen Treasury yields continuing rising to the top. Normally, that should put pressure on what? On gold. But instead, gold continues to make new highs, right? Whatever time frame you look at it, right? If we go to the monthly, you can see gold has been up on the month. Yes, it has been down the past couple of months, but when you look at it from a higher time frame point of view, you can clearly see that gold has been making what? Some higher highs, some new highs. This tells us that investors are responding to something much bigger than interest rates, right? They are worried about inflation, right? They are worried about inflation, right? So let's talk about inflation a little bit. Let's talk about inflation a little bit so that you guys can understand what's really going on. Inflation simply means the purchasing power of money is what? Is declining, right? Imagine today you have $100, right? Hypothetically speaking, that money buys groceries, fuel, and other necessities. Now imagine prices increases over the next year. That same $100 buys fewer goods. Your money has become less valuable. That is inflation. Good example for those in South Africa. We've got the 10 Rand store. It started as a 10 Rand store. It sells coffee, muffins, a whole lot of confectionaries. Started with everything was like 10 Rand. Whatever you buy there, whether it's coffee, whether it's muffin, whether it's a pie, whether it's anything, it was 10 Rand. Right now, that store has now increased their prices to like 14 Rand per item. You see, that's inflation in a nutshell, right? When inflation rises, investors begin looking for assets that can protect their purchasing power. For thousands of years, gold has served that purpose. Unlike paper money, government cannot simply print more gold whenever they want. Its supply is limited, making it one of the world's most trusted store of what? Of value. Why investors are ignoring higher treasury yields, right? This is the key lesson, guys, that you have to take note of. Investors are not buying gold because it pays interest. They're buying gold because they believe inflation may remain high for a long time, right? Even the treasury yields are rising. Even though the treasury yields are rising, right? Investors are asking themselves a different question. What happens if inflation rises even faster than those yields? Let's use an example, right? Suppose treasury bonds are paying 5%, right? Suppose treasury bonds are paying 5%, right? Sounds attractive, but now imagine inflation is running at 7%. Although you are earning 5% interest, your purchasing power is still declining by roughly 2%. In reality, you are still losing money. That is called negative return, right? Institutional investors understand this very well. Instead of focusing only on interest income, they focus on preserving purchasing power. That's why they continue buying gold, right? That's why they continue buying gold. So what is the market saying, right? Before I continue, this lesson basically, guys, is for you to understand the dynamics of the relationship between the treasury yields and gold, right? So that you can apply it into the market. Like what we are seeing today, something is up, something is going on in the market, right? When gold rises at the same time as treasury yields, the market is sending a very powerful message. Investors are effectively saying, we are not convinced inflation is under control. This also suggests that investors may not fully believe the Federal Reserve will successfully bring inflation back to its target. Whether that's true or not is less important than this market trade expectations. And right now, many institutions expect inflation risk to remain elevated, right? That expectation alone is enough to drive money into the precious metal, into gold, right? So what is it that the institutional traders are watching, right? So for us as retail traders, it's easy to focus only on the gold chart. Everyone likes to be on the precious metal. Everyone likes to trade the precious metal, right? Everyone likes to trade the precious metal. As retail traders, it's easy to focus on it. Institutional traders don't do that. They monitor relationships between multiple assets, right? So when analyzing gold, right? When analyzing gold, the institutional traders, they watch treasury yields. They also look at inflation expectations. They also look at the Federal Reserve policy. They also look at DXY, the US dollar index, and they look at economic data such as CPI and PPI. These are all inflation data. They understand that no market moves in isolation. Every asset tells part of the story. The more pieces you can connect together, the better your understanding of market sentiment becomes. So yeah, in conclusion, guys, right? Normally, rising treasury yields are bearish for gold because higher yields make interest-bearing assets more attractive. However, when gold continues rising despite higher treasury yields, it's often a sign that investors are more concerned about inflation than they are attracted to bond income. You see, in other words, they are choosing wealth preservation over interest income. This is why understanding macroeconomics is so important, right? It is very important for us as traders to understand macroeconomics. The chart only tells you what happened. We can look at these yields here. They can only tell us what has happened. We can look at dollar index. It can tell us what has happened. We can look at CHF. We can look at pound. We can look at gold. They only tell us what has happened. Macro analysis helps you understand why it happened. And when you understand the why, you are able to think more like institutions that move the markets. So yeah, if you found this lesson valuable, I encourage you to watch it again and take notes. Understanding the relationship between gold and the treasury yield is fundamental building block for macro trading, right? In the next lesson, we'll continue expanding our macro framework by exploring how treasury yields, the US dollar index, inflation, and Federal Reserve policy interact to influence gold and the broader financial markets. Until then, stay disciplined, guys. Stay patient, and remember, don't just learn to read the charts. Learn to read the story behind the charts. I'll see you in the next lesson. Goodbye.